Kathy Wood has famously said that ARK doesn't buy anything she doesn't expect will rise by 15% annually over 5 years. Is that your minimum expected holding period for an investment in ARK? And what kind of investor is that a good fit for?
Yes, no, that's a great question. So when we look at the valuation of these underlying companies, right, and this is part of our bottom-up work that we do at the individual stock level. When we look at valuation, we don't look at kind of a one-year price target, which many investors tend to look at, right? Sell-side analysts, that's kind of what they're focused on, 1 year, maybe 2 years out. We're looking out minimum 5 years. And so what we've done is establish, when we do our valuation work, we have a bull case, a bear case, and a base case for each stock valuation. And that valuation is based on our 5-year expected price for that stock, right? So we're looking at, and a lot of that valuation work is driven or informed by our top-down expectation at the technology level, right? So if we're expecting, for instance, DNA sequencing technology to compound in terms of growth and adoption to grow at 35-40% per year over the next 5 years, we would expect some of the companies that are the key enablers in that space to experience revenue growth that is generally in line with that growth, right? And so that's really it's more the top line growth that we're focused on, which gets us to that 5-year expected price target. And from there, you just compare, the current stock price today, and you can calculate that expected compound annual growth rate over an annualized period. And so our minimum hurdle rate is that 15% over that 5-year period, right? So for a company to be included in the portfolio, we want to, based on our base case valuation, we want to be able to achieve that 15% annualized return. And the reason why we have that 5-year is, we're not catalyst investors. It's very difficult actually to forecast kind of short term, especially how the market will respond to some of these companies. And in some cases, the market just continues to discount the potential because some of these opportunities are so far in the future, right? Maybe at 3 years out. So for instance, like autonomous driving, that may not actually fully commercialize for several years, but it doesn't mean you should value those portion of those companies working on that like Tesla. You shouldn't value those businesses at zero, right? It should be baked into the price. And so, that's what we're trying to exploit, right? Is that valuation. In terms of our investors, so we aren't buy and hold. That's kind of, one, people just assume, given that we have such a long-term time horizon, that we will be kind of buy and hold investors, but we're actually quite active in our trading. And the reason for that is, innovation is inherently controversial, right? And because of the increased volatility that we're seeing out there in the markets, that actually creates opportunities for us. And it's actually a good environment to work in because we can trade around that volatility. And if you look at the individual stocks that we own and the technologies that they are focused on, you'll notice that the underlying technologies are actually idiosyncratic to one another, meaning DNA sequencing stocks move in a different direction than robotic stocks. And we have broad exposure to each of those areas. And so they're moving in different directions. That provides overall diversification within the portfolio, but it also helps us manage the volatility around those individual holdings.